Welcome back, everybody, and it is another beautiful Saturday. Every week we do these market updates, and there's no marketing. The best part is you just get some solid metrics, so make sure you watch all the way through the end. We do put in chapters. This is May, and so we are going to do a recap of April, and what is that predicting? In other words, like the title says, will the April market predict what's going to happen for the rest of the year? And there are some very compelling metrics that are going to indicate some very, well, let's just call it some positive news. Now, understand, there's a lot of folks out there that are doom and gloomers saying, oh my God, the market's going to crash, it's going to go down, mayhem and bedlam. Okay. Then you have the other folks that say, well, you know, it's going to stay pretty flat. All right. Then you have the people saying, no, actually, I think it's going to head in an upward trend. Our prediction, and please feel free to go back as far as 2007. I think you go back that far. We do drop some of them off for relevance, but we do reference a lot of them. Here's the thing. In fact, check out the Fox News interview that was done a few years back, and people are like, man, that is freakishly accurate, because we're pretty accurate about this. We've been doing it a while. So anyway, here we go. What is really going to happen for the rest of the year? What's going to happen in May? What's going to happen over the next couple of months versus at the end of the year? Well, first, we're going to have our, yes, you guessed it, trifecta. Vacation trifecta is on the cusp. The end of the month, May, we have Memorial Day. I'm pretty sure I get that one right. I think Labor Day is later. I always get the two backwards. Nonetheless, we have a vacation coming up. Then we have students getting out of school or people planning vacations, weather's getting nice, and we have July 4th. So from about the late part of May until July 4th weekend, it's going to really slow down. It is normal. For buyers, that is excellent, because there's a lot of other buyers out doing other things, transitioning lifestyles, things like that. From July, they post to July 4th weekend until about, I would say, mid-August, mid to late August, mid-August, you're going to actually see a spurt of activity. Why? Because people are going to want to secure their homes for the end of the year. We got school. We got people wanting to make a move. It is a very popular time, but put on the brakes. When we hit the end of August, right? Well, then we have Labor Day. Pretty sure that's right. Then Labor Day, and then we have school that starts. And so then the market basically is kind of cricket until we hit basically, I would say mid to late September, and then we will pick up until about mid-December. That is a normal cycle for us. So you're asking, what's going to happen? Well, here's what's going to happen. We're going to see some pretty aggressive activity, and then we are going to see a slowdown. And you're going to hear some people talk about some of our numbers shifting, and that will be important, especially for sellers, to keep perspective. Now, remember, price is your first impression. Super, super important to understand. Setting all that aside, let's take a look at some metrics, and let's go through what we saw. Again, we're going to put in some chapters so that you guys can break it down into nice pieces. Staff is supposed to break this up into a few multiple videos so you can bounce from one to the next. Month-end reporting is always a little bit longer. All right, so let's take a look at this. First, Jerome Powell. Yes, we said it last week. Be advised about the Wednesday shakeup. And shockingly enough, Jerome Powell did not say anything catastrophic. Rates did pop back up, but then they came back down again. And that's actually really good, because where we were at, about 7.5 last week, we're at about 7.25, 7.22 this week. That's a quarter point adjustment, which is really good, because we got some very good information from Jerome and the rest of the minions out of their head shed. Now, here's the thing. Keep in mind, they're also talking about taking the quantitative easing away, which, for those of you that don't know, that's removing, basically currency from the market. Okay, this is a generic level for those economists, those higher depth people, keeping it simple. Taking, currency out of the market to create a little bit more scarcity to try and fight down inflation and whatnot. Didn't really have the effect that they were looking for. So they're going to start scaling all of that back pretty aggressively in June. What will happen? Predicted, we're actually probably going to start to see some mortgage rate drops, not Fed rate. Feds have nothing to do with the mortgage rate, but make sure you're watching the, let's pull this back up again. Make sure you're watching the Treasury. Remember when I said the 10-year Treasury and the mortgages go hand in hand, as far as mortgage-backed securities, go hand in hand as far as following each other. They have no relationship to each other, but freakishly they follow it. And you can see the last little trend there with the red arrow down. You can actually see where that's transitioning in a downward trend. And treasuries came down also. Why? Well, because Janet's doing a little many spending items that they need to start scaling back. Because why? Well, socialism only works until you run out of money. That's my humble opinion. That's my short political view. All right, moving on. Let's get back to this chart. When we take a look at this, and then when we take a look at the next one, this is our kind of our headlines. Home prices apparently don't care about high mortgage rates. And then, of course, ARMs, we're starting to see some activity as far as more refinances because of people pulling cash out, doing different things. There is a great, there's two programs out there that allow you a zero cost up front to get your home market ready, and then it's paid out of escrow. If you want some information, drop us a link down below. We'll tell you about it. Okay. Understand, people are still buying homes, and we're going to see this shortly where our pended sales are up. Our solds and everything else are super, super tight, even though we've seen a mild uptick in inventory, which is seasonally normal, not abnormal, seasonally normal. We're seeing that uptick, which is super awesome, okay? The other thing is, on the right-hand side, let me blow that back up. Hey, listen, if you're deciding if, what would my rent versus buy payment look like over a 7-year window? And then, of course, what would, up to 7 years, I should say. And then, of course, if I were to buy a home today, what would that be? That is a free calculator for you guys to have. We will put those links down below. Look, go use them. There's no cost. There's no login. You don't put your name or email. Nobody knows. If you have a question, however, you can email me that. It will email me a snapshot of what you have. We can answer a question. No marketing, just help. All right, moving on. All right, when we move on to the next one, we got Freddie. Freddie, as you all know, Fannie Mae, Freddie Mac, FHA, VA, all those guys. These guys happen to have one of the better charts. You can see that we were trending in a downward, then we started heading upward. Now we're flattening out. And I say flattening is it's a very generous statement. It's a curve, right? It's at the precursor of the curve. How's that? Anyway, are we going to expect to see rates to come back down into the sixes? Possibly in June, because the investors, and we talk about the investors, we're talking about the stock market, right? We're talking about the investors because, again, mortgages are publicly traded. So remember that. So as the market does its thing, if the investors like the reduction of quantitative easing, right, then mortgage rates will actually go down because bond rates will go up. And the 10-year Treasury, well, it should go down too. Just saying. All right, let's move on. If we take a look at what's happening in the MLS, and let's compare that to what happened in March. Let's pull this up real for you. All right, hang on a second. Here we go. First of all, April was without a doubt a seller's market. So we had listings came up about 18.6%, which really you're going to see here in a little bit. That's not much. When we talk about the number of sold listings, we're actually up 13.6% year over year. That is a big deal. When we talk about the number of contracts that went pended, that's up 18.7%. From the previous month, and then 22.3% compared to the prior year. Again, a really big deal. The month of inventory, we're about 1.5 months of inventory. What is super important to understand is, you see, normally it was 4 to 6 months of inventory was a balanced market. We haven't seen that since 2000. Well, let's see here. If 2006-07, then we had our massive increase because of the foreclosure debacle and the bank failure debacle because of bad mortgages. So 2011, we started drawing down inventory. So I'm going to say since 2011, we have not seen 4 to 6 months of inventory. Haven't even come close. And in fact, in the last 5 years, we have been hovering around 2 months. So I'm calling that kind of the new norm. 2 to 3 months is our balanced market, because even here we're seeing more of a balanced market, and that is super important. Let's take a look at our metrics here. In fact, let's just blow it up one more time. So when we see new listings just on our 7-day running average of 1,457 versus number one pended 1,434, again, the third week that the number of homes barely eked out on a Friday what pended came on the running average, of course, 1,128. Now, what's super interesting about that chart right there is that historically, the pended have been running about 300 to 400 homes more on average than what has come on market. And the solds are about right where they are, and that's pretty consistent. We did see an uptick in some canceled and some expireds, or what we call the sellers just absolutely did not listen and missed the market. Unfortunately, there are options for them, and there are ways to reconsider for them. That's a different conversation. If you have a question about that, feel free to ask. No strings attached. All right, let's move on here. We talk about what's going on with actual, with actual sales price per square foot. You can see our upward arrow there. It's a beautiful arrow. And you can see how the actual cost per square foot of sold homes went up. So in basically this year, we were at $420 per square foot, which is up 2.4% from last month, which was $410, or about $10 cheaper. But we're up 11.4% above where we were at last year, where we were only at $377 a square foot. So we've seen that increase. We have seen consistently that increase, despite the next chart here, when we talk about the actual absorption, how many homes on market. Now, you might be saying, George, do we have a flood of homes coming on the market? The answer is no. Do we have scarcity in the market? The answer is yes and no. Because if our new norm is 2 to 3 months and we're at 1.5 months of inventory, that means that we're actually pretty close to where we should be. And when you take a look at the other chart, it says, hey, here's our new on market and here's our pendant. And they're right, running neck and neck with each other, right? That means that we are looking at a pretty balanced market. Now, granted, our inventory is about 50% less than what it historically has been, which is a good thing that it's not, because it keeps, and our market is in check. So we're not horrifically a seller's market. We're not horrifically a buyer's market. We actually are pretty balanced, in my humble opinion, right now based on these metrics. So keep that in mind. Now, again, if you want super accurate information, like and subscribe to our channel. It just tells us that you like what you're hearing. Ask questions. We normally get back to people in about 30 minutes. Let me know. Moving on. When we take a look at the chart here, we can see that April actually outperformed April of last year. And granted, last year, that's when people were seeing the catastrophic benefits of mortgage-backed securities being sold instead of being bought by the government. And now interest rates went from 4 or 5% up to 7, almost 8%. Now we're back down to 7.25%, and people are acclimating to that, as you can see very clearly in the chart here. If we blow this one up, okay, you can see that the for sale and the solds, they are starting to plateau just a little bit, which is totally normal, right? And if we blow this up a little bit more, so when we take a look year to date, okay, our average sold price is up 10.5%, or $831,000 throughout the Northwest MLS. The year to date active for sale price is $1,038,000, or down about just shy of 5%. Now, when we take a look at the month of April, look, we're only down about 4.1% for month of April, year over year. And the month of April, we actually saw a average sold price of $871,000, or about 11% higher, almost 12% higher than what we saw last year. So we've been seeing a positive trend. We've also been seeing a reduction in market times. So we went from 54 days last year to 38 days this year. So we're seeing, basically well-priced homes. Key thing, well-priced homes moving off relatively quick. Super important for sellers. If you're a seller and considering, price, again, is your first impression. Make sure you do not overprice. You will become a statistic. Buyers are so smart. Just saying. All right, moving on. Well, let me take a look at the numbers on the bigger scale here. Let's blow this bad boy up. All right, we take a look at the numbers on the bigger scale, both year to date. You can actually see, let's pull that up one more time. You can actually see, look, our active at the very top, we're only 985 homes higher than where we were at last year, even though 12.5% sounds like a big number. Now, the big number is the number of new on market. Shocker here, 3,654 more homes came on in April than last year. Super cool. But look at our pending. We're only 113 homes off year to date. That is massive considering we were seeing double-digit numbers last year. And then, of course, our pendings are up 677. We take a look at just the month of April, year over year. Look, we're up 18, almost 19% as far as active, 32.4% for new on market because we saw a massive influx of homes coming on the market. New construction played a big role in that. But look at this, our solds. Our solds are up 13.6%. And then, of course, 22% on pended as far as year over year numbers. And we are seeing some very positive and gaining traction. Now, granted, we're going to see a little bit of softening, seasonally normal softening as we come into our vacation trifecta. All right. Now, as we take a look at new construction is super cool. New construction has been holding its own. As you can see, it's been inventory and sales have been consistent. Some people say, George, that's really flat. Well, I would certainly hope so, because if we saw massive swings, that would be bad. Having this flat means we're seeing consistency with new homes coming on market, new homes coming off, plats continuing. We saw a little bit of a reduction in inventory. Part of that is, again, seasonally normal. Some of it is time of year. And again, even nationally, we're up 8.8%. Now, the super cool part about this, we take a look at this new construction year over year. We're just a tad bit over as far as, and we're just talking like a couple of homes here, as far as available active on market. Second line had a 21.3% increase in inventory. But if we go down to the next line, solds, we're also up almost 12% as far as number of homes that closed and appended. They're up 9.2%. And that, again, is a big deal as we're looking at trends, moving forward, because new construction has been truly a holder in this. Why? Part of that is because of the incentives that they offer. A traditional seller can do the same thing. They either just don't know it or they just don't want to do it. And maybe it's too risky. I'm not sure. But note, new construction is absolutely killing it and has been for the last 2 years when everything else has been kind of diving down a little bit. In fact, when we take a look at these are just as of today, these are rate buy downs from two different builders. And if you want to know where these move-in ready homes are today, here they are. And if you're like, well, I need to sell my house. Well, there's cash offer options out there. You just need to let us know and we will make sure you get that information. Drop the link down below, send me a message, give me a call, doesn't matter. I'll show you how to get a cash offer on your house so you can secure one of these and better interest rates. New construction, we take a look at, this is super important, Charlie, let's blow this bad boy up. When we take a look at this, new construction year over year is only down 1% as far as active homes. That's a nominal number. That's a pretty small number. But average sold prices are actually up 3.2%. So we are closing that gap, okay? And when we take a look at the chart here, we can see super clear that even though we're down just year over year, just a hint lower, and that's only just a couple of homes as far as the pending, but our sales are actually up year over year. So when we blow this up, we can see year over year, Actives are down about 2.5%. New on market's up almost 6%. And sold is up basically 0.6%, just a few homes. And then, of course, just a few homes less on the pended side. What is super important about that? Because we're even seeing that consistency from the beginning to the end, and even when we look at April year over year, all of our April numbers, everything, active, new on market, solds, and pended are all higher. We outperformed last year, and even though last year was really good for new construction, we outperformed that last year. And we will probably continue to see that all the way through, albeit month end is going to be super important for a lot of folks who want to secure best builder pricing. Just saying. All right. When we move on, we talk about bank-owned homes. Okay. Bank-owned homes, again, are just, it is a sparse amount. Okay. These numbers that you're going to see, you're going to say, wow. They're not. They're sparse. This is 3/4 of Washington state. This is a massive area. And so even our defaults are super low. We're not seeing much on defaults. And there's so many different options out there that, banks can work with, and even credit unions. And again, a shout out to credit unions, which I think are just awesome sauce. They treat your members well. They give you special programs. There's great ways of absolutely having a fabulous relationship with a credit union. Just saying, and you don't become a number necessarily. Anyway, there you go. All right, so let's blow this bad boy up. All right, so when we take a look at this, we can see that year to year, year over year, and year to date, again, just super awesome. So we have 11 home difference if we even include the wall of shame sellers, which there are 6. So technically there's only 5 ones. But anyway, even with that, there's only 11 homes difference year over year. When we talk about new, we have 12. Again, we need to drop that back down. And even if we leave the others alone, you can see all of our numbers are very positive in the sense of what's coming on market is absolutely going off market. When we look at April, even though we had fewer homes, 4 to be exact, coming on new on, we actually outperformed what we did last year in every category as far as bringing inventory off. Why is that important? That's important because what we're seeing with these tiny little numbers, that banks are not discounting foreclosures. They are not discounting bank-owned homes. They're doing paint, carpet, and vinyl. They put it back on the market, and they're getting market value for them and getting it relatively well. Their market times are in the 20 to 38 day range, subject to condition and price. Price again. Sellers, keep that in mind as you're looking at going on market, or if you are about to become an expired or canceled statistic. Just saying. All right. We move on. Remember, smash that subscribe button. Have a little bit of fun with it. Share it with 2 people that you like and 1 that you don't. Make sure that you ask your questions. And here's the thing. Because it's free, the metrics are consistent. Go back, take a look at prior weeks. Enjoy it as much as possible because, well, I have a good time. And as you can tell, it is absolutely not scripted. And when we talk about making sure you're getting the right loan, hey, especially now, 5 questions to ask on getting mortgage rates. If you don't ask those questions, you will get bit. I'm just telling you, it's going to cost you thousands and tens of thousands of dollars when that matters. Well, I guess only watch the video if you're interested in saving money. How's that? All right. In the meantime, have an absolutely fabulous weekend. I will chat with you guys, and I'll see you on the next video. Take care.